Today I've got an economic article for you, or more on the economic side. This one is called The Broken Economics of Databases. It's made by a past colleague of mine called Almog Gavra. I hope I'm pronouncing that name right. He's a very bright guy who worked in Confluent with me, and he's now starting a company called Open Data. So let's get into it. Why database companies charge so much, earn so little, and keep making things complicated? Why do they do that? Why do they do that for real? Well, let's figure it out. The database industry has a strange economic problem, and this post attempts to lay out the foundation for why that's the case. It will cover some concepts from Economics 101 and hopefully answer the question, why is it so expensive to pay someone to run my database? And that's a question I've been thinking about a lot for a while as well, as I worked in a managed Kafka service, on a managed Kafka service. Why does it cost so much for us to run Kafka for somebody? Why is somebody running a 1 megabyte per second Kafka cost so much money, even in the cloud, even if you deploy it yourself, or if you pay somebody else? I mean, I've had numbers where, I'm not sure if I can pull this up, but let me try. Even if you try to run a Kafka that's, let's say, 10 megabytes a second of writes and 10 megabytes a second of reads per second, like it may cost you up to $35K a year. Self-hosting this yourself on Amazon. This is because of all the costs of network traffic, of storage, of EC2 instances, etc. Now, you could optimize this a little bit, maybe get down to 32K or whatever. But again, 32K a year for something that's doing 10 megabytes a second is a lot. And now, add on top the fact that if you're buying this from a vendor, the costs can usually be around 100K. 100K for this type of service is not unthinkable. It's actually pretty standard. I believe in it. It might even be more than that. So the question then is like, why does it cost so much to run a throughput or run something that's open source software most of the time? I mean, Kafka is mostly open source, and it can fit on my Raspberry Pi. Why does it cost so much? Well, I think the same thing applies for databases. You can run a Postgres, and it can, again, cost a lot of money. I'm not sure if it can go up to 100K. I don't have a lot of expertise there, but I'm sure it can be some astoundingly large numbers. And the core reason for this, and this is what this article dives into, is that it's just the incentive structure and basically the business side of it. Like the way the business is structured, the way the organization that sells the database is structured, gets at a price which cannot really be substantially lowered without the business going bankrupt. Again, the short version is the database vendors have incentives that push them away from simplicity and towards defensibility, resulting in databases that seemingly get worse over time. Disclaimer here is that Almog is working on an open source database project called Open Data that was partly motivated by the dynamics in this post, but this is the only time he'll mention it. I'll mention it once. Open Data, from what I understand, is a collection of open source databases built on a common object native storage and infrastructure foundation. As far as I get them, their idea is to utilize S3 or object storage to outsource a lot of the tough challenges of building a database like replication, consensus, scalability of the storage layer, etc., auto-scalability, elasticity, these sort of things that take a fair amount of, a lot of work to do and get right. S3 already solves it for you, and it's usually cheaper than doing it yourself. So these guys are basically saying, hey, what if we just built extra code on top of S3 to give you the abstraction of, let's say, a time series database or a log or a vector database or a key value database while using S3? In theory, that should help us give you a product that's easier to run and also a lot cheaper. There are a lot of other projects in this space, like SlateDB, which is a very popular one. And it's basically, as far as I understand, like a framework or library to build some of these higher value projects on top of S3, but that's the most I'm going to get into this for now. Making sense of earnings reports, the first paragraph. There is some puzzling data available in historical earnings reports of public database companies that were acquired or shut down. Cloudera, that got merged, I think, with Hortonworks, and I think it was acquired by private equity. MariaDB, which I'm not sure what happened, and Confluent, which just recently got acquired by IBM. By the way, expect a video on that very soon, where Almog was a relatively early employee. Our reported gross margins between 78 and 91%. So again, all these three companies that eventually sort of died, you would say, got acquired or got acquired by private equity or shut down, they all had high gross margins between 80 and 90%. That's a lot of profit. In a traditional economic sense, gross margins this high are pretty rare, and you'd expect these companies to be wildly profitable. It is clear that none of the referenced companies were, because obviously they didn't continue working the same manner that they did. For a database company, gross margins are the ratio between the amount of revenue the company brings in and the cost to sort of run the database. So if I'm sending you a database for, let's say, 100K a year, how much is it costing me to run that database? The accounting here is pretty loose, as our accounting is, but there are in essence two factors that play into the cost: the hardware cost and the operations cost. So the hardware cost is more obviously measurable. This is what the company pays, let's say, the cloud providers for the hardware, or they pay for their own machines if they're hosting it themselves. The operation cost is estimated based on the number of engineering hours spent on call and other operational tasks. When I was at Confluent, this was the result of a survey that accounting sent out to the engineering teams asking us how much time we spent on operations. As you can imagine, that's an imprecise estimate, but investors care a lot about it. Now, I never saw this directly when I was in Confluent, but I learned from Almark that this was something that was sent to the managers, and I was fortunately never a manager. I don't like working as a manager. But yeah, I guess this is how Confluent measured it. But again, gross margins, basically, you make 100K from the database. Let's say the customer is paying you 100K. They're wiring you 100K to your bank account. You're paying, let's say, 40K to AWS to host or to pay for the EC tools and all the other load balancers and stuff you're paying for. And the rest of the cost is sort of, call it the virtual cost, like how many engineering hours out of this engineer I pay 100K a year salary for did he spend to make sure this service is running. Now, this doesn't take into account the R&D that took to create the service or to create the cloud service you're selling or to create the database or stuff like that. It's just the operational time time spent to make sure the service works. If it breaks, you get paged. How many hours are you spending on that, etc., etc. It has a graph here that shows the revenue, the operations percentage, and the hardware percentage cost. He's sort of making up some numbers, I guess. So if we say that, let's say, out of 100K revenue, you're paying 18K to the engineers who are keeping it running and 11K for the hardware, obviously a lot of that is pure profit. That 70% here is basically pure profit for you. What explains this half of the story is the operating margin, which indicates how much, I think he meant to say what explains the other half of the story, the operating margin indicates how much of the revenue went towards R&D, research and development, sales, marketing, and administration, basically the rest of the business. How much did it cost to run the business? After accounting for all of those other things, these companies generated actually very modest margins, from 2 to 8%, and actually deep in the red if you include all GAAP expenses. Now, GAAP is these generally accepted accounting principles in the US, which is how you account for revenue. Generally, any sort of financial market wants every company to have the same accounting standards so you can model them in the same way and compare apples to apples. But as you know, in tech, we have a lot of non-GAAP accounting. And I think the main reason we do this is because stock-based compensation, meaning I'm paying you, let's see if the Wikipedia page has it actually, meaning the company is paying you in stock, should actually be accounted for in the earnings. So again, if somebody is paying me 100K for the database, and I'm paying the engineer 18K of salary, base salary, okay, that's 80% operations. But if I'm paying that engineer also 100K in stock-based compensation, then that should also be accounted from the margin and everything else. And these companies, all these database companies, these tech companies creating hard new software, innovating, they pay a lot in stock. As you know, an engineer in the Bay Area can earn, up to $1 million actually, but let's say something on average just like 300 to 500K. A large percentage of that money is coming from stock-based compensation and not from base pay. So a lot of these companies are not accounting that at all in their revenue models. And that's what makes them seem profitable. But actually, if you account for that, they're deep in the red, meaning they're actually losing money. Confluent was one of those companies. And generally, the whole market is full of these. But anyway, continuing on, the operating margin here is, let's say your gross margin is 71%, your sales and marketing is 40%, your R&D is 22%, and your administrative stuff is 9%. Your leftover operating margin, again, not accounting for stock-based compensation, is just 7%, so you're barely profitable to begin with. And as Almar continues, these gross and operating margins are interesting on their own, but together they paint a concerning economic picture. Database companies depend on a delicate balance, and even a small sustained dip in gross margins can be fatal. It can push them to losing money and eventually dying off, and I agree 100%. So, just from this paragraph, which is 20% of the article, we can already say that data infrastructure companies are bad businesses. They're lousy businesses. It's not a good business to be in, I don't think. And I have more to say on why that's the case. Continuing on, monopoly and competition. In economic theory, there's a spectrum between monopoly markets and perfect competition. At one end, a monopolist has a meaningful control over the price and therefore the demand of the product. And at the other, firms sell effectively identical products into a market with many competitors. So any one firm has almost no pricing power. Economics represent this by relating marginal revenues, MR, that's the revenue from selling one more unit, and marginal costs, MC, costs to serve one more unit. How much does it cost me to sell you a unit? And this is all with respect to demand. Firms, whether they're monopolies or not, they want to increase the output so long as selling one more unit brings in more revenue than cost, i.e., if you're selling a new unit, that brings you profit. This equilibrium is noted with MR equals MC. Now we can explore the intuition using a database example. Almog loves to pick on MongoDB because they're generous enough to have detailed public pricing. An M50 Mongo instance, this is in their Atlas Cloud product, is priced at $1,460 a month. They choose this price intentionally, he says. Imagine the alternatives to help understand the intuition behind this condition. At $2,000 a month, MongoDB would make more on each sale, but they would likely lose enough customers that the total profit falls. So this is pretty easy to imagine. If your price is low enough, I think it's called the Jevons paradox, if I'm not mistaken. If you have 1,000 customers paying you $100 a year, or let's say $1 a year, so it's easier to count, you'd make $1,000, right? If you have 500 customers paying you $2 a year, you'd again make $1,000. Now, the theory is if you are at the $2 mark, let's say, and you have 500 customers, by lowering your price to $1, maybe you won't get 500 new customers, maybe you'll get 2,000 new customers. Maybe you get, like when you lower the price 50%, maybe you end up with 2,500 customers, and obviously that's making more. They make 2.5K a year rather than, let's say, 1K. And vice versa. If you raise the price, then you're making more on each sale, but if people move away from you, they buy something else or they just stop buying, then you're making less money. So Almog is just painting this picture here. Again, at $2,000 a month, they make more on each unit, on each database, but they'll probably lose more money as a total profit or total customer base falls. At $1,000 a month, they'll win more customers, but probably won't be enough to make for the lower revenue per database. And somewhere in between these two numbers is the best point, also called the Goldilocks rate, that preserves high margins but remains low enough to avoid losing too much demand. Now, there's no perfect way to answer what that price is. It's kind of trial and error, really. Like it's more of an art than a science, but nevertheless, that's generally how companies think about these things. Now, the math looks very different depending on the shape of the demand curve. Now, we're really getting into economics here, so I promise I'll skip over this quickly. But I think what he's trying to show here, and I'm not the best at reading demand curves, is that there's two extremes here, basically. So in a perfect competition, there's... no, actually, I won't pretend to understand this chart at all, so I'll just skip it. In a perfect monopoly, the firm's own pricing decision meaningfully affects the quantity it can sell. If MongoDB was a true monopoly and was the only company in the world selling a database, customers may dislike the pricing, but they will not have a close substitute, so they'll probably just buy it. Their alternative is to not have the database. In a perfect competition, you get the opposite. They will dislike the price and they will just choose somebody else. If there were 1,000 vendors selling a truly identical, M50 MongoDB cluster, Mongo can't raise prices without losing those customers to cheaper alternatives. So even if they raise prices and make more on a unit, they would lose a lot more customers and generally make a lot less money. So it could not sustain cut prices below that cost forever. The reality is that Mongo lives somewhere in the middle. The question is, what characteristics does the database market as a whole have in the long term? Now, how many vendors are there? What's the pricing competition like? How different are these databases? That's a very important thing. So again, he says here, the answer depends on how different databases actually are. Postgres and Kafka are relatively different systems, and you're usually ill-advised to use them interchangeably. I don't agree with that. Confluent's Kafka and Amazon's MSK, on the other hand, are close substitutes. In economic models, even a single close substitute can quickly erode margins and force vendors to compete on price. The Bertrand paradox. So there's a lot to unpack in this paragraph. But basically saying, when you have a market like Kafka, you have Confluent's Kafka, which is way better than open source Kafka and even MSK, I believe. But they are close enough substitutes that somebody may move from one to the other if the pricing does not work out well for them. And this puts pressure on each vendor because if you're interchangeable, you're not making any money. So you have to innovate to not be interchangeable. You have to innovate with features that lock in the customer, that give them a lot of value, etc. Otherwise, you're basically going to lose your high profitability. It's more or less inevitable because the more profitable you are, there'll always be somebody selling at a lower price than you, especially if that somebody is Amazon who can really afford to sell at a lower price, whereas somebody like Confluent really cannot. Now, this thing comparing Kafka and Postgres is to this article that actually Gunnar wrote, and he wrote as an article, as an answer to one of mine in a very snarky way, like looking to make the front page of Hacker News and da-da-da. And we had some arguments here. I had a very long comment basically addressing this article here. So I don't really agree with the fact that you're ill-advised to use them interchangeably. It really depends on what you're using it for. Again, this comes from a comment that I made back in the day that people are paying $100K to use Kafka for a megabyte a second. And in a case like that, you would actually rather use Postgres, honestly, because a megabyte a second is nothing, even if Postgres is not like a Kafka. For that small amount of throughput, you can really use anything. It would be more or less fine. But again, this is a separate video on its own. Continuing on the close substitute argument here is that, so let's see what the Bertrand paradox is. I asked Claude to define this for us. So imagine two cloud providers are selling identical compute instances. The classic economics says that with many competitors, the price drops gradually. The Bertrand paradox says with just two sellers of the same product, the price crashes immediately all the way down to the minimum cost. Why? Because if AWS charges $1.01, GCP will charge $1. Then everyone will pick GCP. So AWS would undercut by 1 cent, and then GCP undercuts by 1 cent, and they undercut, and they race to the bottom, quickly going to the marginal cost, which is the cost to provide the service, like the minimum cost they can offer. So that's apparently the paradox, that you don't need a perfectly competitive market with thousands of players to get a commodity pricing. Two can be enough if the product is truly identical. Now, this thing here by AI is not a perfect explanation because there are a lot more factors that play into it, including the product is not truly identical, including stuff like switching costs. Like it costs a lot of money to actually switch a cloud provider. This is the best example, right? The same thing as database. The real-world escape hatches are what make it interesting. Differentiation, the lock-in, the APIs, the experience, the switching costs is something I want to touch on, the capacity constraints, and the brand loyalty. So, yeah, SaaS companies do a lot to avoid falling into a Bertrand trap. And I think that's what Almo kind of meant here. In economic models, even a single close substitute can quickly erode that profit and force vendors to go to the lowest price possible. That puts significant pressure on vendors to avoid becoming interchangeable, else they risk losing their high gross margins. So that's why vendors really try to, implement a lot of stuff to differentiate, to lock people in, to do all sorts of things like that. Let's continue. Why do vendors need high margins to begin with? There's an interesting parallel to draw between two seemingly unrelated markets, databases and pharmaceuticals. For both, the initial R&D investment to bring a product to market is substantial. It takes a lot to create a new drug, and it takes a lot to create a database. Now, a comment I had here is that for SaaS companies, this innovation or this sort of investment is also continuous. Like when you build a database, it's usually never enough to just keep the database as it is. You always have to continuously improve it, especially as other people are building the same sort of database or building something just as good as you are. Whereas with drugs, you get this different thing, like you build the drug, okay, it's good enough, then you put a patent on it, and first of all, people can't create the same drug. So from what I understand, they cannot create a drug that works in the same sort of pathway for that way until the patent lives. So it's a one-time R&D cost. You basically create the drug, it's like a spike of investment, and then you create the drug and you profit off of it for many years after. Developing a serious database or a successful drug takes years of specialized work, but selling one more unit of either isn't particularly expensive. And again, you develop the database, you develop the drug, you just sell a new one. It doesn't cost like a database. It doesn't cost me more to create a new database once I already have the code. Economists describe this as high fixed costs, the cost to develop the initial product, and low variable costs, the cost to manufacture a single instance. This creates a basic requirement where the initial investment has to be earned back somehow. Whether that happens through high margins, high volumes, or a mixture of both depends on the demand curve. So again, your drug can be extremely profitable, or you can be selling millions of the drug, or you can be doing both. And you have to do that for a few years to recoup the costs. Now, a quick side away, it's very important we think about economics here, because economics are what drive life. Nobody works on creating a database. 99% of people in big, large team efforts don't work on creating a database out of, just sheer boredom or something like that. It's out chasing economic value. Everyone is trying to make money. Companies are trying to make money. People are trying to feed their families and have a nice job that pays well. So in a way, it's actually very important we understand economics if you want to have a good understanding of where the tech world will go. It's just inseparable. Even though as engineers we don't really think about it, it's extremely important to think about. Now, there are a few ways that this can play out and where the comparison with pharma becomes useful. In both industries, the company whose R&D investment results in something genuinely innovative can charge what's known as a Schumpeterian rent. These are temporary profits that exist because competitors have not yet caught up. So again, when you create something that's brand new, you can charge a high premium for it. I don't know, what's a good example of this from recently? Like I would say AI, but it's actually not that expensive. But if OpenAI came out and they were the only ones with ChatGPT, and instead of $20 a month they charge like $2,000, there would still be a lot of people that would buy that because there's literally no alternative and the technology is brand new. Now what happened with AI is that everybody else started offering the same product, so that profit margin went away. But again, if you come up with something entirely new, you can make temporary profits that exist because the competitors have not yet caught up, and the customer cannot buy anything else. So if they really want your product, and if your product gives them value, they will buy it at whatever the price is. During this period, the original company is effectively a monopoly. You can charge as much as you want for insulin or Kafka if you're the one selling it. Now, I think insulin is particularly, a great example here, because if you have to buy insulin, if you're going to die without it, then you're going to pay whatever the price is. And Kafka, not so much, but again, if you really want a Kafka and there's nobody else selling a Kafka, you can charge high prices, you can get away with it. And that's what Confluent did for a long time, at the beginning at least. The core tension here is that innovation is not the same thing as sustained value capture. Innovation creates the temporary pricing power, and after that you're sort of on a treadmill, like you're running away from everybody else who's trying to catch up. And this unlocks temporary high gross margins we see in the earnings report, but maintaining that requires constant innovation and sustained R&D costs. I also said here that it also requires high value innovation, innovating on things people care about, because if you innovate on something that nobody wants to buy, it doesn't really matter. And that's what makes it so difficult for these tech companies, is that you innovate once, you make something like a Kafka, which is truly innovative and truly solves problems for people. It's actually really hard to get that second innovation. It's really hard to make something on the level of Kafka after that. And I think the same applies for companies like MongoDB or any other sort of tech company. You may have like one or two major innovations in your company's life cycle, but ultimately you can have infinite. It's an extremely hard problem to solve. And I think that's also a reason why these companies are really on a treadmill or on a sprint against time, where they both have to innovate really fast and make something really valuable, and then they have to figure out a business model, a moat, a lock-in, or they have to reach escape velocity and become big enough so that they can continue profiting off of that without dying. And I think that's why a lot of startups also die, because you can create this innovative thing and you can be profitable for a while, but then if somebody copies you, if AWS comes and bundles your feature into their big product suite, you may just die overnight. A good example here is the AI companies. I mean, not the AI companies, but these AI adjacent companies, like some of them like Midjourney, or not even Midjourney, but some companies that wrap, let's say, OpenAI's API, and they give you a value service like, create a picture of whatever, like try on some clothes furnish your house, some sort of higher value add services like that. Because there's probably no other such service on the market, they can charge some money and get profitable. But what happens with OpenAI puts it as a feature on their website? It's over for you. You can't sustain it. You innovate a little bit, and then somebody copied the feature, even if it's not as good. They can offer it for a much lower price, and your profits go nowhere. And I quote Peter Thiel here, but I didn't introduce you yet to it. So in the book 0 to 1, Peter Thiel actually argues something similar that this article argues, is that the only good business and the only good tech business is essentially a monopoly. You don't want to have competition. Competition kills all the profitability and all the good things about being a business. And the way he argued it here is that competition destroys profits. So Thiel argues that in a perfectly competitive market, nobody makes any real money. When they're all selling roughly the same thing, the prices immediately get driven down to the lowest cost. And it's miserable. And then he says that competition is not good, at least for the business. It's good for the consumer. So if I'm buying a Kafka, competition is great. I want a lot of competition because I just want the cheapest Kafka at the best price. But for businesses, it's awful. Thiel pushes back against the conventional wisdom that competition drives innovation. He says monopolists actually can innovate, even though practically I think they don't, because they at least have the breathing room to do so. Whereas companies that are locked into some fierce competition are really too busy fighting for their survival to think creatively and try to innovate. Now, they might still try, but ultimately they don't have enough space nor enough resources to really try to be creative and innovate. And this is something that happens with databases as well. I think that's why we get sort of petering out of databases. Like some company comes up, innovates with some really cool thing, and then it just becomes worse and worse and worse, as Almog here, I think, implied a little bit on the top, why databases seemingly get worse over time and they don't continue innovating in the same way as before. Right. So, yeah, basically, competition is bad. That's really the takeaway here. Let's continue reading. Sorry, getting lost in this big thing. All right, and yeah, you need innovation because, as Peter Thiel says, competition copies your innovation fast. So your competition is always going to try to at least catch up to your innovation. So if you want to maintain the profits, you need to keep innovating. And that requires a lot of R&D work, which is very expensive, as we already went over it. In situations like this, who captures value from an innovation is shaped by two factors: appropriability and complementary assets. Appropriability, I also call it just a moat. Like a moat defines how easily an invention can be imitated. And the complementary assets define what is required to monetize the innovation itself. The reason the pharmaceutical industry is a useful foil is that it tends to have a stronger answer to both questions. Government-issued patents create a much more formal moat regime, i.e. there's a patent, so you literally cannot sell my drug, I'm going to make money from it. And the path from inventing a drug to monetizing it is usually more directly controlled by the innovator. The big pharma companies, they have their own manufacturing, or they have strong relationships with manufacturing, so it's kind of hard for you to create your own drug if you're a brand new company. Similarly, it applies to AWS, who have their own cloud and their own machines. So it's a little bit more difficult for you to create something like an S3 than it is for AWS because they have access to the machines. Again, the databases do not get the luxury of government protection, so vendors have to rely on weaker defenses like closed source code, restrictive licenses, and the operational know-how. I don't think operational know-how on how to run a database is a very good defense because it's hard to market that. Nobody publishes their SLA numbers outright like that, so nobody really knows how better you are at running Kafka than, let's say, somebody else is. But I guess rumors help with that and whatever. But yeah, if you close the source code and if you don't share it, then technically nobody can copy it. But these are not reliable barriers in the long term. And the half-life of these protections is quickly degrading with advancements in AI. That means the Schumpeterian rents from database innovations usually decay more gradually and less predictably than they do in pharmaceuticals. The idea here is that even if your source code is closed, we can just copy it. Like we can not copy it, but we can ask AI to create something along those lines. And it's probably not too difficult now that creating code is easier than ever. The bigger problem here is in the complementary assets. In pharma, the innovator usually has a much more direct claim on the assets required to commercialize a product. In databases, the crucial complement is the infrastructure and hardware that runs the system. Like I said, the AWS example, which is typically owned by cloud providers like AWS rather than by the inventor of the database. And this asymmetry is the core of the industry's strange economics. Bringing it back to the demand curve and what options are available to vendors, it starts to make sense why they must sell databases at high margins to survive. They need to recover high fixed costs in a market where the innovation diffuses rapidly and the protection is weak. And the owners of the key complements, let's say the cloud providers, are structurally better positioned to win a price war. Most simply said, if I'm a customer of AWS, let's say I'm MongoDB, I'm selling a database, I pay AWS $10 for that EC2. AWS is making a profit on this. AWS, maybe their internal costs for the EC2 is probably $5, okay? So AWS's MongoDB can, in theory, sell their Mongo for much lower price because it costs them $5, not $10 to run that instance. This is the hardware cost component. So in a way, they have that structural advantage, similar to how the pharma company has advantage in manufacturing the drug itself. And then, this is pretty obvious. The only strategy to continuously generate innovations to renew the Schumpeterian advantage is to differentiate in some other manner or change the business model. But continuously generating innovation requires additional investment, which has significant fixed costs and starts the cycle all over again. So you have to create a new innovation, you have to charge Schumpeterian rent on that, and then eventually that thing decays, so you have to do a new tier. It's an endless hamster wheel. And here's why databases become worse over time. This conclusion on its own is not especially troubling. It's good that vendors have to keep innovating if they want outsized profits. The problem is that if these innovations run dry, which they do because it's really hard to innovate, the company ends up resorting to tactics that hurt the product to avoid a price war with AWS. The bad truth here is that the useful feature set of a database stabilizes relatively quickly. By that he means only a few features are really useful and worth paying a high premium for, and the rest of the features you may need, you may not need. Now, do you really want to pay 3x the price for database for a feature you don't need? Probably no. So database developers tend to release a wealth of new features to stay ahead of the competition, but on average, these features don't get adopted and they don't bring a lot of value. And at worst case, they may actually bring issues because this is software. After all, the more stuff you put in, the greater the chance for problems. When feature development is no longer enough, and the focus shifts from pure product improvement to avoiding commoditization. This is more like shady business tactics, like he's going to tell them here, but like hiding your prices, bad faith marketing, locking people in, having bad contracts, etc. There are three characteristics of a commodity: fungibility, price transparency, and low switching costs. With a mature database, fungibility tends to rise first. Now, fungibility means how interchangeable is this database. A Postgres by AWS versus a Postgres that's self-hosted versus a Postgres by some other vendor is basically very fungible. They're replaceable. It's the same Postgres API. It's usually the same database under the hood. If the most buyers view multiple managed offerings of the same database as close enough, then the remaining levers of differentiation have to be shifted elsewhere. You cannot, if your Kafka is the same as MSK's Kafka, then you have to use other stuff to avoid being a commodity. Some of those levers can be healthy and even benefit developers, Almog says. Sometimes a vendor creates high switching costs by providing such tight, high-quality integration across a bundle of services that detangling it is simply not feasible without a significant investment. This is also kind of called as a lock-in. All databases want this kind of defensibility, but few achieve it. Databricks is one of the clear success cases. As far as I understand this, is basically, hey, yes, we sell Spark, we sell Postgres, but our Postgres connects to other stuff in your system so well that it would be a lot of work for you to redo all of these things. In other ways, just saying that there's a lock-in here and the switching cost is high. And thankfully, I have a whiteboard here to draw to you. If we run the same comparison, I guess let's say two cloud providers, because it's just an easy example. And let's say I'm a company, and AWS is charging me $1 million a year, and I'm currently on AWS, so currently on these guys, and GCP is charging me $800K a year. They're offering me something cheaper. I would be saving $200K a year if I switched from AWS to GCP. That's awesome. Like, you would want to do that, right? But then when you get into the economics, you actually figure out why this doesn't happen as often. And I think intuitively as a developer, you can tell why you would not switch from AWS to GCP just like that. I mean, it's a shit ton of work, frankly said. But let's walk through it just to get an example. Let's say your switching costs you would evaluate to be around 2 million, which is the time it would take to switch, the amount of developers you would need to work on, changing your systems to integrate with the new API of GCP and all these other things. And of course, the opportunity cost of that money, those developers can be working on something else. What else? I think that's it. Let's say, just hand wave, your switching costs are like equivalent to $2 million. Now, if you're saving $200K a year, that means it will take you 10 years to pay back those switching costs. So really, you'll be saving $200 a year, but you'll actually be break even from this savings after 10 years. And only on year 11 would you actually see real savings come into your business. And the big question every business asks itself is, what can I do with those $2 million? Is there a way that I can invest those $2 million today somewhere else and make more money out of it, apart from, let's say, the $200K I would make after year 11? And this, I think, is the so-called cost of capital. So, well, actually, no, cost of capital is a little below, but cost of capital, as I define it, is what do investors of your company want from your money? Like, how much do they expect you to return off of, let's say, that 2 million that they are giving you? Because for you to have 2 million, maybe you're earning it because you're a profitable company, or maybe you sold stock to some investors who gave you the money and they expect a return on that stock investment of theirs. So the cost of capital here is, what do investors demand as a return for the risk of holding your stock versus putting their money elsewhere? I.e., if I give you $2 million to your company to invest, I expect you to give me, let's say, some percentage return on that investment compared to, let's say, putting it in bonds or in gold or in Apple, whatever. And again, this matters depending on the company, and how much money you can make out of that 2 million depends again on the company. But, I have two company examples here. I have something that's really a commodity, which is a government-mandated water utility company. So the company that gives water to your home. Usually it's only one per city and stuff like that. So it's a very safe business per se. And you have something more innovative, like let's say Starlink. Starlink is internet everywhere and satellites. It's only one of them. There's no second Starlink. So the cost of capital of these businesses is sort of different. Like something like the water thing is an extremely safe business to never go anywhere, and it's probably going to be here in 40 years. So your cost of capital is something lower. You would expect, like if I'm an investor, I put money in that water company, I would expect, let's say, 5% returns on that capital. And if that business cannot give me 5%, I'll be like, okay, whatever, I'll buy some bonds or I'll buy something else. Whereas for Starlink, because it's, I guess, more risky, it's a newer thing, it's unproven, it might get out-competed, etc., I will demand a higher return, let's say a 10% cost of capital. So as an investor, I want you as a business to be earning me more than 10% of that 2 million I invested you than something else. And given that percentage now, we can calculate, okay, if I'm Starlink and I can move to GCP and save 2 million, what's the percentage? Like if I compound my capital and I find a way to make 10% out of that 2 million by investing it in some other product, how much money would I make after 10 years? And with 10% compounding, you get the magic of compounding, you'd get 8 million after 10 years. So after 10 years, that Starlink company that invested their 2 million to a new product, to getting new engineers, building something new and making more money, would get 8 million as a return. That's a lot of money. Whereas if they invested in switching to GCP, they would barely make the 2 million back, and then they'll be making 200 a year. So they'll basically never reach that 8 million thing. But so for a company like Starlink, it's pretty obvious that, hey, like saving 2 million after 10 years just because I'll switch to GCP doesn't matter too much to me. I don't care about it. It's insignificant money to me. I don't need to save on this thing. I just need to focus on making more money because I'm such a profitable company and I'm in a good industry. So, and that's kind of what you see. Startups happily get locked into something like Vercel or Superbase or any of these like younger startup companies that charge a premium because those startups value the ability to move fast. And for them, losing, let's say, 2 million over a few years is nothing because they can make a lot more than 2 million over those 2 years. So they want to invest that money in something more profitable. Whereas for some old boring company that's maybe dying or maybe can't make any real money, like a government water utility company, their cost of capital is lower. That utility company with $2 million extra probably cannot make a new feature that sells more. I don't think they can sell more water to people or whatever. So their cost of capital is also lower because it's a safer business. So a 5% cost of capital on $2 million after 10 years goes to only $3.2 million. So $3.2 million is kind of harder to argue against. If I have like a completely safe, risk-free way to earn $2 million or basically save up those $2 million after 10 years versus I have to invest in something risky to make more than 3.2 million after 10 years, you may just prefer to invest the 2 million in something safer. Now, again, this is just a long tangent of mine to say that even though you're saving what seems like a lot of money, that money is never looked in isolation. It's always looked in relative value. Which again means if I can save 2 million after 10 years, I mean, that's cool. But if I have high confidence that my business can earn more than 2 million after 10 years, if I invest those 2 million today in something else, then I would rather take that bet. So that's how I explain to myself why switching costs are really high. Switching happens rarely, even if something is a lot cheaper, because almost always the software cost of a company, the cost of the infrastructure, of the databases, of the engineers, etc., is usually, while it's expensive, it's still somewhat low to the overall value that the company brings and the company makes. An oil company that's mining oil off the ground, making, let's say, $1 billion a year in selling oil, especially now with the wars and everything, they probably aren't paying $500 million for software, or even $100 million. They're probably paying $10 million for software, for whatever software they use. I'm just making that number up. They're probably paying $10 million for software out of a $1 billion revenue company. Is not that much. Even if you can lower it by 30%, you can get that $10 million down to $7 million. All right, that doesn't really change anything. So you would rather use your extra money to invest in something that might change your 1 billion number, because if you can get, let's say, 10% more oil from the ground to investing in something, that can earn you 100 million versus saving on the infra cost. So this is how I explain to myself why a lot of businesses don't really always focus on getting the cheapest possible data infrastructure solution or cheapest possible cloud provider or cheapest possible whatever when it comes to software, because a lot of times these costs are relatively small compared to what the business does. So this is just my way of explaining everything. I think this is important to know because you have to look at the higher level as well. Like a database company's profitability matters. A database company's profitability is only as high as its customers' profitability. If dying companies or unprofitable companies are buying your database, then you may go out of business soon because those customers may die. So again, it's worth thinking about these things when thinking about database economics or SaaS economics, which, you could take this argument too far, because at the end of the day, the whole economy is connected. So you can never think of anything in isolation. But again, I think it's a useful way to explain why high switching costs, or even switching costs in general, why switching a database is harder than it seems. And I think it also explains why somebody could pay, let's say, $100K for a Kafka that does something that a Raspberry Pi can do, because that Kafka gives that company a lot more value. Like that $100K you're paying for Kafka might be earning the company millions a year. So to them, it's a rounding error, and they don't care. And they only have X amount of people, X amount of time, X amount of focus. They'd rather spend that focus on something that's giving them more money rather than saving some small amount of their profit. Okay. That was a long tangent. Continuing on, where did we leave off? Yeah, so we're talking about the integration here and the switching costs. And Almo continues. Some levers are toxic. Vendors can, and they do, manufacture price opacity by hiding behind complicated pricing schemes. Snowflake pricing, for example, is so complex that Gartner released a full report that you have to purchase to help you understand and negotiate your bill, which is just insane. But look at this. How to best negotiate and manage your Snowflake contract, published in 25. Data analytics leaders face challenges in accurately forecasting Snowflake usage and managing the committed spend. Use this research to develop an effective negotiation strategy and optimize the contract terms to balance the discounts and flexibility. This is just insane. Like, why is it this complex to buy like a database? Really, like, do we really need to have these big reports that some like consultancy firm, which by the way, these guys themselves are a scam. I can talk to you about that in some video. But do we really need so much analysis? Like, we have to pay analysts to analyze the pricing of these vendors and figure out how to negotiate better, etc. There's just so much complexity for what's just like, just give me a database, man. But yeah, it's a complex world. And there's another more subtle lever, which is the operational complexity. To see why, we can revisit the Mongo example. If you recall, an M50 is priced at $1,460, but the equivalent cluster of running 3 R5.X large instances in AWS costs only $360 a month. Meaning, if you want to run your own database with Mongo's open source or whatever product, it will only cost you around $360 a month compared to $1,460 a month if you run it yourself. This means that MongoDB thinks that it's reasonable for you to value the operational work they do for you at $1,100 a month, or 3x the hardware costs. Now, this isn't an exactly apple-to-apple comparison, because I believe the MongoDB they're selling you in the cloud has more features than the open source one, but still, roughly speaking, we're saying that, okay, yeah, the hardware costs like whatever, 30% of this or whatever, but the other 70% you pay for the operational benefit, meaning you don't have to pay engineers to manage your MongoDB. And Almog then says that, hey, if that's the case and the hardware cost is only 30%, then who cares about getting the hardware that cheaper, if making it cheaper? If you manage to reduce your hardware cost by 50%, which is a huge reduction, you need a huge optimization for that, you will only reduce your price by 12%. You won't reduce your price that much. While if you manage to reduce the price of your operational costs, meaning again the engineers that are on call for managing your service, then you're going to reduce your price by 40%, which is a much larger number, assuming, of course, the savings are all passed directly onto you. And we have a cost breakdown here of the MongoDB cluster, the cost, the end cost, and the EC2 instance cost. And if you cut your hardware cost by 50%, you're only getting 12% savings. If you cost your operational cost by 50%, you gain 38% savings. That's 3 times that. And this creates an uncomfortable incentive structure. MongoDB doesn't want you to make your operations easier. They want to sell you the high Mongo M50 instance, so they don't want the open source version to be that easier to manage. MongoDB has strong reasons to make operations easier inside Atlas, but weaker reasons to make the database easy for everyone else to operate. I kind of have the feeling here that Almog wanted to talk about Confluent, but didn't, because obviously we were employees there, so it's not the best of optics to talk about a company you worked on so openly. But everything I read here about Mongo really applies the same for Confluent and Kafka. Like Confluent selling you Kafka, they have strong reasons to make the operations easier inside Confluent Cloud, but they have weaker reasons to make it easy in the open source space. Like, why would they? They would be working against their own proprietary advantage. Operational expertise is, after all, the largest part of what the managed service is selling. If the system becomes dramatically easier to run by yourself or everywhere else, you'll be less willing to pay a lot of money for it. So, yeah. In other words, they're incentivized to do the opposite. The tougher it is to operate a database and the more specialized the expertise required, the harder it is for competitors, including you hosting yourself, to offer an equivalent experience. Now, this is important. Again, the more specialized the database is and the harder it is to operate, the more of a competitive advantage you have. This doesn't happen overtly, and I agree with that. Almog has been a database engineer his whole career, and he can guarantee us that they're not sitting around trying to make systems harder to run for no reason. I can tell you the same thing. The dynamic is a lot subtler. We're rewarded for adding functionality that helps the product stand out, and each additional layer of functionality tends to make the system more operationally complex. Over time, the database becomes more capable, but also more interesting to debug at 3 a.m. when the pager goes off. I had a comment here. we're also rewarded for making the database easier to manage. Like inside the companies, we're also having trouble managing these things, and we're always implementing stuff to make it easier to manage at scale. The only difference is we're not open sourcing that because, again, it's not like the strategy. You don't have an OKR every quarter that says, hey, make this more complex to run or etc. It's more about how do we make our own profits bigger, which is an extremely normal thing, like every company is trying to make money. So that's a normal thing. But again, you cannot escape the incentives. So that's why every database becomes either harder to run for no reason or does not become easier to run for no reason. On the other hand, if we had, let's say, a purely open source database, you would be incentivized to make it easier to run. And if you had nowhere else to contribute your improvements, you would contribute them directly to a database and you would make it easier to run. But again, with these open source companies, open core companies that basically sell open source software in a proprietary way, they're just making their own stuff easier to run. And again, to summarize, the market incentivizes defensibility over simplification, of course, because if you simplify it, AWS gets the simplified version as well, and they get to sell you that simplified version for even a cheaper price. And this in turn results in databases getting worse, or what I would call they just don't get better over time. Before we reach the end, I want to talk a little bit about competition and why competition is so bad for database companies. On top of everything else, let's try to get a summary here of what we talked about, which is, okay, let's do paragraph by paragraph. Again, companies make a lot of gross margins, but when you take operating margins into account, they're actually losing money because of stock-based compensation, just because it costs a lot to make an innovative product. There's a very delicate balance here. If you're not a monopoly, you're going to lose money because the competition is going to drive all the prices down, and you're basically going to be making less and less from each product, and you're going to be fighting harder just to survive and just to make enough to feed this beast of your overall company spend. There's some tough equation here of what your product should be priced at, and everybody tries to come up with that number by their own. It costs a lot to create a database, as we've talked about, and depending on your moat, depending on how much access you have to cheap, let's say, EC2 instances or whatever else, that price can be higher or lower. And some companies have advantages there, like, let's say, AWS. The bigger companies have bigger advantages. So smaller companies have to do, shittier stuff, like closing their source code or adding a restrictive license or keeping operational knowledge private, stuff like that. They just have to survive in whatever way. And I have another point to make here, which I don't see it being talked about enough, but it's also the fact that massive competition, massively huge competition, eats up profits in other ways, and not just in the way that the price goes down, but also in the amount of work you need to spend to actually make a profit. I think a visualization will make this perfect for you. So I have one for you. Let's say you want to buy a Kafka, okay? I'm some customer, and I come up and I say, hey, guys, I want to buy a Kafka, and my budget is, let's say, up to $200K, all right? If there was just one vendor, that vendor would sell me a Kafka for $200K, maybe make a little discount to $190K, and I would buy it. And that would be the end of the story. But if I have more vendors, then I get all of them to compete against each other. So that's portraying how the price gets lowered. Like this guy tells me, the blue confident guy, whatever, tells me $200K. I talk to other people. Some guy gives me $150K, and they bundle something to me. Some other guy gives me $130K, and some other guy actually negotiates down. And I tell him, hey, man, like I got a $130K offer. I'm talking to all these other guys. Can you give me something lower? And he says, yeah, I'll give you $100K. Because maybe that company is just so hungry for revenue and so hungry for money that they'll sell it at the cheapest possible price. Maybe not even at a profit. Maybe some companies really, they just maybe at a point where they're dying and they just want to make it to the next VC round. And to make it to the next VC round, you have to show them that you're making some money, that you're getting some customers. So even if they're losing money off of the deal, or if it's not sustainable, they might still undercut everyone by a massive amount just so they can get the deal, just so they can survive the next VC round, so they can have another shot at creating a new innovation. So that's also why I think you can get like very low prices here in that sense. And then they offer $100K for 2 years, which for this small startup here is like, well, we might be dead in 2 years anyway, so let's take the money we can. It's better than zero. And also you may just be incentivized by the commission of the sales guy. The sales guy may not even care about the company. He may just want to make more money for himself and just get his commission, because sales gets commission from every sale they make. So that motivation can also, change the price that you get for something, depending on the guardrails of the company. But what I want to focus on here is, are you noticing something? This is all of these people, all of this is extra work that would not exist if these vendors didn't exist. It didn't exist. If these vendors did not exist, okay, if we did not have 4 vendors but just one, it would have been a much faster sale. You literally just text the company, hey, I want a Kafka, and the guy says, cool, here it is, and you buy it and that's it. But when you have so many vendors, then suddenly you're getting a lot of back and forth. And what usually may be a short-term deal may take, let's say, months to finish, now may take years, because suddenly you're talking to 5 sales guys. And one of them is creating FUD about the other. They're creating all sorts of things to talk about, saying, oh, these guys don't work. Oh, let me go back to them and ask them, hey, does this actually not work? Or are you is your product better? They say, no, we're actually good. Let me prove it. Then some other guy comes and says, hey, have our POC. We have the cheapest product. Try it out. They try it out. They spend 2-3 months trying it out, but then they figure out it doesn't work. So they go to somebody else. And I'm basically trying to say that all of these companies are creating work between each other. And this is work that would not exist. If this customer has to try out 4 different solutions and talk to each of them and negotiate and pit each customer, each vendor against each other, then each vendor has to work disproportionately more to get that same amount of 200 or 100K revenue. So in a highly competitive market, not only is your price that you're getting going down, but the amount of effort you need to put in to get that revenue is going up. So you're getting squeezed from both sides. You have to hire more salespeople. You have to hire more marketing to stand out. And, of course, you have to engineer more as well, but you have to hire more sales and more marketing to just get that sale to begin with, to just get the sale. So in a way, your costs are also going up as well. And I think that's something that Almog didn't touch on, but he should have, because Kafka is one example, but databases, who isn't selling a database in 2026? I feel like there are 1,000 companies every day just selling a database. Who was that guy? Database report. There was this guy, a really awesome guy. I'm completely forgetting the name, but there was this guy that posts an annual database report, annual state of databases or something like that. He works at some university. He's very famous. This guy, Database 2025 year in review. If it loads, maybe it won't load. Pavlo was the name of him. Pavlo, database in review. Apologies for technical issues. Let's see if we can find a copy of this somewhere else. Andy Pavlo. Yeah, this website is not loading. We'll get the picture here. But this guy, every year, he posts a really nice review of what happened in the database world every year. And you see from it immediately, here's a copy. You see from it immediately that there are so many companies. All of these links here are different companies and they're different databases. Do you want to count them up? There's so many all the time. And this happens year after year after year. So all of these databases are competing against each other. So imagine, let's say, let me count. I won't count it, but let's say 20 databases here. They're not competing for the same workload per se, but conceptually speaking, imagine 20 such vendors talking to a single customer. It wastes so much collective time. There's so much collective salespeople effort that needs to go in just to get that one sale. And out of these 20 guys, out of these 20 vendors that we're going to have here, only one person is going to get the sale, right? Only one person. So all the other 19 people that spent effort was basically just wasted effort. That's the cost of getting the sale, but generally wasted effort because it resulted in 0 revenue. So that's another way I think competition really kills infrastructure vendors and any sort of company's profits. I think it's unaccounted for. Here in this example, just with the Kafka thing, you have a total salary of 400K a year out of all these 4 vendors trying to earn and trying to compete for a 100K a year deal. That's revenue, not profit. So this is a cost on top of this one. And again, this is competing for a 100K deal that might have been actually 200K if there was only one guy. So yeah, it's not easy to compete. It's really not easy at all. Let's go to the end of the article now. The end. You may not have sympathy for multi-billion-dollar database companies, and that's fine, but the inconvenient truth is that most database development and OSS software development at large is funded by enterprise. It's funded by profits, which means that your user experience is directly dictated by company profits. And I agree 100%. What sort of database you get, how good it is, everything along that is dictated directly or indirectly by how good are these businesses doing, how profitable are they. And this is some report that he linked here, which compares paid versus volunteer work in open source. Now, I won't read through the whole thing. This is from 2014. But what do they find here? They find that 50% of our open source development is paid work for many years. And many small projects are fully paid by companies. So I agree with that. I would probably think it's even worse. And in fact, let me show you something else. I have a picture. I did this analysis on Apache Kafka's contributions, so the contribution to the Apache Kafka project. And it's a little bit of a stale thing because it accounted for all-time contributions from 2010 to 2025, which basically means that today, in the last few years, this might be a little bit different. But, looking at it from a historical view, here are the percentage of total commits made by the top 100 contributors grouped by company. You can see that 70% of all Kafka contributions were made by Confluent directly, which is a good way to say if Confluent wasn't there, Kafka would not exist, really. Like 70% of the code base, not the code base, but the commits are by Confluent. And by the way, proportionally speaking, these are all like high effort commits, whereas some of the other ones are usually lower effort or like some test fixes or some typo fixes, etc. Second one is LinkedIn, who created Kafka. So you can look at this as Confluent as well, in a way, because Confluent emerged from LinkedIn. Then you have the open source community from Taiwan, which I did the Kafka Community Spotlight, Taiwan. Let's see if it gets up. Basically, these cool guys that work for free, actually. So this is actual open source development that they're doing. Really awesome folks. It's a big community, by the way. Let me see if I can load it. They are like 8K followers. There's a big community, basically, of people that just contribute to open source. So they're number 3. They don't have Red Hat, they don't have Unknown, they don't have Ivan, Cloudera, Uber, yada, yada, yada. A few of these companies make money from Kafka. Red Hat sells Kafka solutions, I believe. Who else? Amazon sells a Kafka. Ivan sells a Kafka. Cloudera sold a Kafka. Hortonworks sold a Kafka. AutoMQ sells a Kafka. Confluent, of course, sells a Kafka. So if these companies did not sell Kafka, they would not be contributing to it. And another thing is, if Confluent was not doing as well, if Confluent was not as profitable, if it did not have as much VC money, if it was dying earlier, etc., they would not have contributed as much to Kafka. And basically, I'm saying here that like all the software you see is a direct result of corporate profits, and the health of the company depends a lot. The quality of the software depends a lot by the quality of the company, of the business that's making money off it. Almog continues. You likely also need no proof that the hyperscalers are not a solution for this. Their incentives are not particularly aligned with the users either. They're often happy to capture the value created by upstream database companies and open source communities without taking the same level of product risk, meaning they don't take innovation risk, they don't try to create new features, they just copy and they make money essentially for free. They don't even contribute to open source that much. I mean, look, Amazon has done only 120 commits to Apache Kafka, and I think their business is like 3 times that of Confluent in terms of how much money they make from Kafka. So that gives you a sense of how much they're actually investing into it. Not to mention somebody like GCP or Google, who I don't think contribute at all to Apache Kafka, and they also have a Kafka product. Cloud providers are excellent at scaling proven systems, but they're much less motivated to make the kind of focused, opinionated bets that produce new categories or invent new features in the first place. Since Almog has already inundated us with economic theory, and the post is quite long in this video as well, he ended with a glimmer of optimism. He thinks that object storage is already making a different economic model possible. It's a generic solution that's enough to absorb a large share of the heavy infrastructure burden, meaning you use less instances and cost less in hardware, while also being simple enough to serve as a foundation for building narrower, more focused systems on top. That changes the fixed cost equation in a way that could matter a lot and opens the door to lower margin business models, meaning business models that do not need to charge extremely high prices to keep themselves profitable. because because object storage basically deflates the cost of building software. Just like WarpStream built a Kafka on S3 with just 10 people or whatever they were, by having replication for free, having consensus for free, all from just using S3. They didn't need to write that much code. Whereas Apache Kafka has this huge log layer. They have like a ton of Java code that needs to implement consensus, that can fail, that's not it is well tested historically speaking, but it had to be written anew and tested anew, whereas you can just use object storage and it's already tested, it already works well. So it's an example of how you can build new software by utilizing commodities like S3 for a much cheaper cost. And they're actually cheaper to run as well, operationally cheaper. He doesn't mention it here, but you're not on call for S3. AWS is. So that reduces your operational cost by quite a lot as well. And that's a subject for another post, which I hope we'll be talking about this open data company that he's working on and that we have not yet seen, but I'm waiting for this. So yeah, I guess this is the article. Thank you for watching this video. My takeaway here is that infrastructure companies are really awful business. They're a very lousy business to be in. And I think a great reason for why we see them continue has a lot to do with VCs. Like this money that comes from VCs helps create infrastructure companies, even if they're not great businesses. And I think that explains why in the low interest rate environment that we had in the last few years, ZRP era, let's see if we can get a picture that shows this. This one. The low interest rate era, which was between 2009 to 2016 or 17, and then from 2020 to 2022, we got a lot of new startup investment. Because in a few words, when the interest rates are so low, investors are chasing higher returns. There's a lot of extra money sloshing around in the market, and everyone is investing in all sorts of companies. So you get a lot of new money coming into VCs that invest into new startups, whose startups try to make money by creating new databases, creating new database infrastructure, new software infrastructure. And that's why they can afford to not be profitable for a long time. And that's why they can afford to, innovate once, make some money, not focus too much on money, and try to innovate more and more and more and more and more, and contribute to open source, contribute to Apache Kafka, and make money out of Apache Kafka, because there's just so much money sloshing in the system that everyone just tries to invest in the new thing, and companies want to buy the new thing, which is Kafka in this example. But when the money dries up, when the interest rates go up, and investors start thinking a lot more critically about, hey, how much money are you gonna return me? How much money is this business gonna return to me? What's your profit margin? What's your operating margin? And when you answer something like, well, it's 7% non-GAAP and GAAP it's minus 40, then investors start putting money away, which dries up your company, and your company eventually dies. And by dying, I mean they either sell to IBM, or they sell to private equity, or they sell to somebody just because they can't sustain themselves anymore, or they go bankrupt. But no company wants to go bankrupt, so they usually just sell maybe at a cheap price, maybe at a loss in terms of investment. Like maybe they sell below the cost that they gave you stock options for, or maybe they sell below the cost of their last funding round. But again, they just find some sort of exit, and database usually becomes inevitably becomes worse, because if you were not profitable with a good database, and you cannot make the database much better to make it profitable, then you have to make it worse. You have to lock stuff in, you have to make pricing, you have to hide your bad pricing, you have to lie, you have to do bad stuff just to keep alive and survive. And that's the unfortunate world of infrastructure software that we live in. It's a very interesting question of how this pans out, but I think it explains why somebody like a Confluent, which was such a beloved name, had to ultimately sell out to Big Blue, to IBM. And I'm not sure I'm willing to make a bet on it, but if I have to bet, I think that Elasticsearch, I think that MongoDB, they're probably going to have a similar fate to them. Somebody like Snowflake and Databricks, I can't really say, because it feels like they've reached escape velocity and they're big enough to maybe survive on their own, but I don't know. But for anybody that's smaller than that, I think some form of acquisition it's inevitable. Like even WarpStream, right? Like they did this cheaper Kafka, and they managed to sell to Confluent. They didn't go on to become profitable by themselves. I mean, they just chose an exit because Confluent panicked and gave them $220 million for a startup that was just 1 year old. But let's see what happens with, let's say, TurboPuffer, which I covered on this channel earlier. Basically, a vector database and a search database built on S3. And I don't know what QuickWit is, but I can figure it out here with you. I guess again a search engine on S3. But let's see where these companies go. Like, can TurboPuffer kill Elasticsearch? Can it get acquired by Elasticsearch or a cloud provider? Or can it stay lean and be profitable? I don't know. Time will tell. And let's see what Open Data does. But yeah, I hope you learned something from this from this video and this article. Thanks to Almog for it. You should follow him, bitsxpages.com, and we'll see what his company does. But if you found this video informative, please leave a like. Please subscribe to watch more if you like hearing me speak about stuff. Give me feedback. I'm willing to improve, and I'm still new at this, so I'm still learning how to do all these things. And yeah, thank you for watching. Have a great rest of the day.